Good morning, Professor and my fellow co-managers. A very good morning to you. We begin by focusing on the slide showing the performance highlights of the company. Here we see the trends on the table. I will then show them individually over time. Let's look first at our total annual revenues. We begin at year 5 with a revenue of $334,128 down at the bottom on the net revenues. By year 15, it had increased to $969,987. This was an average growth of approximately 29% per year. From this, we can extrapolate where we will be over the next 2 years, everything being equal. So by year 16, we expect to arrive at 1,251,283.23, and year 17, 1,614,155.37. Our earning per share began at 75 cents, and by year 15, we were $14.50. An astounding growth pattern over the year. After a slight trough for 2 years, from year 10, the average growth went up. Return on investment went from 14% to 120.1, causing our investors to be very happy. Our company began with a credit rating at B, went to A-, stabilized at B+, and has now stabilized at A-. Stock price began at $12 and increased over the period to 406.16. We were the best in the industry. Our image rating started at 70 in year 5, but by year 15 had progressed by 11 points to 81. There were up and down movements in years 9 through 10. These movements are shown year by year on the following slides. You will note that ROE is weighted at 129.6. So we'll move to the following slides. Here you see our annual earnings per share, and you see the trough there where we went down a little bit, and then we continued rising. The credit rating, the annual return on equity. You can see that our annual return on equity began in year 6 at 30.1, and by year 15, we arrived at 120.1, and this is what gave us the average rating. Now let's turn to the next slide. And we see our credit rating. Our credit rating began at 81, and by year at 69, and by year 15, we were at 81. Again, this shows proper management of our financing. Let's go to the next year. Our year-end stock, again, you can see graphically moving straight up to 406.16. We were best in the industry. We made a really big leap from year 14 to year 15. So this is what is reflected individually from the first slide that you saw.
Sorry, it's not, I can't get it to skip to the next slide.
It's not skipping? Oh my. Okay. Yes, here you have the annual image rating. moving from 69, I think we did this before, 69 to 81. Are you getting it to move forward? Okay, that's all, yeah. Should be Latoya. Is Latoya hearing?
Okay, I'm sorry. Can you all hear me?
Yeah.
Yes.
Okay, a little technical difficulty. Okay, our strategic vision is changing the way that you see everything. So, strategic vision, what does that mean? We wanted consumers to actually envision our long-term direction. So, developing a catchy phrase worth remembering was ideal for our company. So, the jingle, changing the way you see everything, encapsulates both our camera and drone segments and also paints a bigger picture of Dyno Cam and Drone's purpose. It helps the company keep a focus on being dedicated to our goals, and it establishes a standard of excellence. For example, our quality methods, product marketing, our service delivery, and our customer service, amongst other things. So we want to be recognized by millions of households based on our brand recognition, our image rating, our reputation, and we've done just that with our catchphrase.
Next, we see our performance targets for the year 2016 and 2017. I have included multipliers so that we are able to see why we arrived at those figures. So we have an EPS, a figure of 27.88 for 2016 and 34.29 for year 2017. We use a growth multiplier of 1.23 to, sort of prophesy where we would be. On the ROE, we move from 118.90 in 2016. We expect it to be around 103.44 using, again, a growth formula. Because we observed a slight decrease over time and we wanted to do it with some kind of accuracy. We expect our image rating to continue in the area of 80 for both years 2016 and 2017. Our credit rating is now at A-, and we expect with judicious management that we'll be able to carry it to A. Our stock price, we expect in 2016 to be 586.09. And by 2017, all things being equal, we expect it to arrive at 843.97. And again, we use a growth formula of 1.44.
For our AC camera competitive strategy, from the very beginning, we decided as co-managers to each have different areas that we were in charge of, which led to our global differentiation strategy. That way each co-manager would have the freedom to decide where they wanted to spend their money in regards to the wholesale price, the advertising, and operating profits. A few weeks in, we noticed that our best results would come from a high PQ rating and high operating profits. We started our PQ rating at 4.0, and we had the most significant jump from years 9 to 12, where we went to a 5.2 and a 7.2, and finished year 15 with a 7.0. With our operating, we started year 5 at 13.1%, and were able to bring it all the way to 45% by year 15. Another thing that was a part of our strategy was not only meeting our investors' expectations, but exceeding them. We found that this was the only way that we would be able to outcompete our rivals. Something that was different specifically to the AC cameras is that all of our geographic areas had the same sales promotion and the same warranty periods. In year 15, we had our sales promotion at 16 weeks for 22% and our warranty period at 180 days. This helped us maintain our high EPS. Here you can see the 4 different geographic regions and how money was spent. So for North America, more money was spent towards advertising. Asia Pacific focused on a high wholesale price, and Europe, Africa, and Latin America had average prices overall to balance the 4 areas. For the UAV drones, we had very similar factors as our AC cameras, again, giving our co-managers the freedom to use their money as they saw fit in different areas. Again, a few weeks in, we focused mostly on our PQ rating and operating profits all the way to year 15. Starting at 4.0 for a PQ rating, our most significant change was in years 10 to 13, where we jumped to a 5.2 and a 7.6, and then finishing year 15 at 7.4. Our operating profits, we were able to finish at 44.1%, having only started with 6.3%. We again focused on exceeding our investor expectations to outcompete our rivals. And the difference specifically towards UAV drones is that in each area we had very low discounts offered, which helped us maintain our EPS. They were different in each area, ranging from 0 to 5 to 9%, but we all had very low discounts overall. Here you can see again, North America had high advertising, Asia Pacific focused on a high retail price, and Europe, Africa, and Latin America had average prices overall. We continued this year after year. Within a few weeks, everyone decided where they wanted to spend their money. So this is just an example from year 15, but I noticed this for almost every year before. For our production strategy, we decided as co-managers to spend money initially installing workstation tables and spaces. And weeks after that, we noticed that we didn't need to install anymore because we had very low overtime and we naturally just had very good results, so we didn't need to add anymore. Another factor for our production strategy was where we placed our money. So we decided to spend money more towards the productivity training versus the employee wages and benefits. We started with our very first year at only having $3,000 towards production strategy in AC cameras and $1,000 in UAV drones. Our average price every year was about $3,200 in production strategy for AC cameras and about $1,900 for UAV drones. In our final year, we spent $3,354 for AC cameras and $2,503 for UAV drones in our production strategy. This all helped us maintain our high EPS as well.
Our finance strategy. As the board is aware, dividends may be paid to stockholders after profits. They are paid not only to reflect the faith in our investors or as a reward to them, but as a strategy in deciding how much of our profits should be distributed and how much retained. We decided to appropriate 6.6% of net profits. If you look under dividend data, 6.6% of our net profits to dividend payment. Each of our 18,498 stock owners received 0.9595 cents, you see it in the corner there, of the earnings that we sent towards stockholders, and this amounted to 16,148. Our strategy is based on planning to make major upgrades in outlays to research and development, as well as acquisitions to integrate forward to 1, reduce or limit costs associated with components and parts. The reason we wish to do this is because we observed that components and parts took 80% of our costs. 2, reduce our susceptibility to suppliers, commanding price and supply. And 3, to reduce or eliminate rivals by limiting their supplies. Because of tight cost controls, Dyno Cam and Drones had the highest profit margin in the industry of 56.3%. So if you look on the profitability, the first one in the corner there, 56.3%, and the net profit margin was 25.4%. Our current ratio represents our assets divided by our liabilities, and at 3.35%, current ratio is under credit rating measures, is good enough to encourage lenders to do business with us. This is one of the things affecting our credit rating. Our interest coverage ratio consists of operating profit divided by annual interest payments and is good at 10.56. Our debt to equity ratio are the liabilities divided by stockholders' equity and is taking more by debt than risk, as you can see. Michaela? Sorry, Latoya. She here now, so she.
Okay. I am here.
Yeah.
Okay. I couldn't get through this slide without saying that we are number one again. So taking a quick look here at years 14 and 15 of the simulation, we can see a few of the companies we consider to be our strongest and our closest competitors overall. In particular, teams being carpentry and critical perception. All 3 of our companies have either met or exceeded investor expectations and has arrived at industry standards in most areas that hold the most significant weight. Having said that, ultimately, our company was able to pull ahead and stay ahead for the past 2 years of operation, reflective in our weighted average and overall game to date score. Okay, next slide, please. Let's take a closer look at our competitor analysis so that we can highlight our diligence and efforts in striving for excellence as compared to our strongest rivals. Now, looking at the illustration, I'd like to point out that we, Company D, have one of the lowest delivery costs in years 14 and 15. Our administrative expenses are the very lowest across the board in between all companies. Our operating profits for both years is also outstanding and the highest. And most importantly, our bottom line, our net profits for 2 consecutive years is above average and the highest in the industry, which we are humbled and honored.
So our competitive actions going forward would be to improve our brand image. As I said before, we will be doing some work on, on that area with product development, increase our market share as a result. We will increase our revenue through the continuation of tight controls. And as I said before, we're going to be increasing in the area of research and development. And as a result of our improvement in our product, we expect to attract more shareholders. The strategy going forward will include integrating forward into the area of components and parts. We wish to reduce our dependency on suppliers for cost and components. So we will look at acquisitions or strategic partnerships in order to do that. The lessons that Company D learned over the period was that we get rewards when we have tight cost control in order to prioritize our profits, that we will continue or we were successful because of good communications. We gained a lot from being a good corporate citizen. As you can see, Dyno Cam was able to win the award on 3 separate occasions of being the best in the industry for our contributions towards citizenship, corporate citizenship. And we also came second twice. We intend to improve our products gradually, and we intend to continue to differentiate our approach to the various markets. Those were the lessons that we learned over the 15 years, or sorry, the 10 years that we performed up to year 15. Thank you.
Okay,